When we talk about PFIX, obviously, as Eric just laid out, absolutely crushing it this year, up about 40% on a total return basis. I'll ask the bearish question. What happens to this fund when interest rates go down? How do you manage for that?
Absolutely. So the quick answer is it goes down. If interest rates rally, if interest rates were to go down, you would see the fund behave exactly as you would expect. It does have an interesting feature to it, though. Remember that options are highly convex. And so this is one of the reasons why it has outperformed the competing products that you highlighted, the inverse ETFs. Bonds themselves, as interest rates go higher and higher, they eventually stop declining and they begin to reflect an underlying interest rate. In the case of an option, it actually gains value. It moves further into the money and picks up what's called the delta. So it's increasing in terms of its effectiveness as it goes up. On the flip side of that, as interest rates go down, this fund, because it is ultimately using an option, has what we call ballast in the form of treasuries themselves. Those ultimately limit the losses in the portfolio to an absolute amount that's been spent on the premium or that currently resides in the premium. So in both directions, we think it's a superior way to trade bonds.
So have we seen, do you think the top in terms of rates on at the end of October when we hit 5% on the 10-year, or does that not even matter to your strategy?
Well, it obviously matters to the performance of the strategy, and it does influence some of the strikes that we're using on the swaptions. So again, the payer swaptions that we're using, we have to choose both a tenor and a strike, and the level of interest rates does influence that. We want to maintain a degree of price responsiveness. Quick answer in terms of where they're going, that's actually not why you buy this ETF. You buy this ETF because you don't know, right? If they move beyond that level, this ETF offers a highly convex, highly levered way to play the move higher in interest rates. It's useful in a portfolio, and candidly, I've gotten the interest rate call wrong this year. My partner, Harley Bassman, who developed PFIX, got it absolutely correct. He nailed it, and from the very beginning, he said, whether you think interest rates are going up or down, the answer is, if you don't know for certain, you want to ultimately hedge a component of it. And he's nailed that trade. This has been a phenomenal product.
Mike, anybody listening to you talk can tell that you have done work in the institutional world. A lot of the people at Simplify have worked at hedge funds. And we noticed, I think Barron's might have, I think, reported it, that GE's pension put $100 million into EQLS, which is one of your long-short ETFs. That is really rare for an indie ETF that's new to get an institutional bite like that. I mean, really, institutions almost never come out of anything that isn't super liquid to use as some kind of operational vehicle. But to put an investment in that is really telling. Do you think we'll see more institutional investing, given that this is sort of like a hedge fund within the ETF world?
Absolutely. We think there is no question that the rule changes that occurred in 2019 and 2020 have opened up the ETF space to be competitive with hedge funds or other strategies in the institutional world. It's not just EQLS that is benefiting from institutional investment. We also have significant institutional investment in our two-year Treasury strategy, which offers a levered exposure to the two-year Treasury. You've obviously heard Stan Druckenmiller refer to his enthusiasm for two-year bonds. This is a way for retail or institutions that don't have what's called an ISDA agreement that allows them to trade the complex options. It allows them to participate in a levered fashion in the same way as an institutional investor might. Similarly, we have ETFs in the bond space that offer bond hedges that are also being used by institutions. So I would highlight that this is a growing trend. GE and EQLS, which we're doing in partnership with Wolf Research as a long-short equity fund, is really just one of many examples of this type of growth.